But can we take one practical example apart from crypto, some other example of blockchain where there is clearly a real life application of blockchain which is there and which is adding value?
It's happening everywhere. So if you need to understand how the crypto space is.
Yeah.
Cryptocurrencies like Bitcoin, particularly Ethereum and others, Solana, AVAX, Luna, these are the blockchains on which the applications are built.
Okay.
They're not the applications themselves, but they are networks, blockchain networks, that if we buy the token, we're participating in the network. So if you imagine that Facebook, the network owners are the people who own the shares. We as users of WhatsApp or Facebook, we just get the utility, but we don't get any value.
Right.
This new world of cryptocurrencies, users have a token. So it goes up in value. So everybody's a participant, an economic participant in the network. But that's that. They're called layer ones. After that is the applications layer. So the first thing that really came out was decentralized finance. So again, to equate it to the Indian world, this is fintech, but fintech that's not being done by the banks or a small startup. It's fintech that is decentralized in nature. So algorithms, matching flows and creating yields and all sorts of incredible stuff that just happens via algorithms. It becomes, and some are centralized, some are decentralized, but this is basically the yields, the borrowing and lending layer, that fintech layer. So that's building massively. So that's our banking system where I can now have my crypto, I can get paid a 5% interest, or I can lend it to you, I can do other things with it, or I can swap it for something else. All of the functions the banks provide us, but there's no middleman, we're not paying the bank. The next big thing that came out last year was non-fungible tokens, NFTs. This, at first, people don't understand because it's like, well, people are trading pictures, digital pictures, and they're going for millions of dollars. This is ridiculous. Yes and no. What this is a non-fungible token versus a fungible token. A fungible token is one Bitcoin is the same as another Bitcoin, but there's a finite supply.
Okay.
Those Bitcoins are the network layer, or let's say Ethereum, it's a better example. Ethereum's the network layer. On top of that, on this chain that records everything, distributed, so there is always one source of truth, which is all of the nodes on the network confirm that what's in that block is correct. So on top of that, you can have a non-fungible token. What that is it's a unique token for a unique contract. So smart contracts are what Ethereum brought to the world. Okay. And that allows you to put a very individual thing. So let's say you're a famous digital artist. You can now create scarcity by saying, well, I'm going to make an NFT of my art. So this is exactly the same as you can have a set of limited edition prints, or you can have the original. So, or you can have the image you've just taken off Google because you want to have it as your screensaver. The one that has value is the original. And then the next value is the scarce supply limited edition prints. So that's what you're doing here, but there's no middlemen because now you can start selling art to people. Property can be attached to the blockchain now. So think of the mess that is Bombay property by some of the title deeds that are owned by 28 families and all of this issue of redeveloping. None of that has to happen. If you think of a property transaction as well, you need a notary to confirm the two parties have made this agreement that needs to be lodged. Yep. Within that, as you know, there's bribery and corruption that takes place. There's difference of prices. There's all of these things. And then when I want to buy that property, because you just bought it, I want to buy it from you. Do I know your title deeds? Who really owns it? All of these things are complicated. If you put property on a blockchain, it's all confirmed. All the legal contract, it's essentially notarized by every participant on the chain. So it means that we have trust. In a digital world where everything moves so fast, we need trusted things. We don't want to go to the notary every time and then get 3 lawyers involved and then go to the bank. We want it all to be trusted instantaneously, which is kind of like India's stack, right? So now you can do your KYC instantaneously. Well, imagine if the whole world does that on blockchain, then everything is interoperable. We can do this all together. And NFTs are unleashing all sorts of things we don't know. Just think of every contract. So insurance will go onto NFTs because you have these new, and then we can sell insurance and buy insurance and trade insurance, all sorts of things. It's like the derivative market's clearly going to go onto blockchain because it's a much better way of keeping track of who owns what and all of these things. And same with the credit markets as well. So there's a lot, and it's only just started, and we're going to see even more developments coming in all of these things.
Correct me if I'm wrong. So basically, there is a network of nodes, and say you have a coin against that, say Bitcoin. So when you are essentially owning a Bitcoin, you're actually literally owning that network. Can I make that presumption? Some piece of that network?
You're owning a piece of the 21 million Bitcoins that make up the final full network. So if the network has value, this is called Metcalfe's law. So Metcalfe's law is how you think about networks. So if you think about, I'll relate it to Reliance in a sec. If you think about Ethereum as a network or Bitcoin, you have the people who buy it, the owners of the network. So people who are trading it, whatever, they own a piece of the network. But the network to be really valuable, you want people to build applications and connect all of these people together.
Cryptocurrencies remain the most popular use case for blockchain technology.
So that is where, when you're looking at the indicators, particularly around recessions, it's hard around geopolitical events and stuff because they tend to be more randomized. But recessions tend to be forecastable. And around that, you can start positioning yourself. So we're starting to see it happening in the US right now. We're starting to see the yield curve turning lower.
Yep.
Usually when the yield curve goes negative, a recession follows soon after. So then you're looking for business cycle indicators like the ISM survey or PMI surveys or sentiment surveys to start rolling over and going below 50, it is in the ISM, which tells you the economy started to potentially contract. Those kind of signals, and then a bit of technical analysis will give you the timing. Now, there's no 100%, there's no certainties in this world. All we do as investors is look for putting probabilities in our favor.
Okay.
And the more experience you have doing that, the better you get at it. And you know, the pandemic was one of those very obvious setups for us in the macro world. The economies globally were already slowing down. We'd had the trade tariff wars with China and the US. Trade was slowing down. Then the pandemic arrives. You saw the outcome in China, which was lock everything down. It went to Italy. Italy did the same. The moment that happened, you knew the whole world was going to follow suit and close their economies. And that looked like, okay, this is a macroeconomic event that we can not only hedge ourselves from, but actually profit from.